rental property. I was an appraiser from '97 until 2018 when I let my license expire. I've been doing this education stuff for quite some time. I am a commissioner on the City of Portland Rental Services Commission, so landlord-tenant law is something I specialize in as well. And then Investor Lab is a networking group that we created here in the Portland area, and so that's where Dan's seen me before in the presentations today. But what we'll get into today is really the rising tide. So, and give me 1 second. I got a courier here. I got to give a document to. Sorry about that. I had a closing today and a courier pick up some notary stuff. So we're going to get into government intervention and really how that affects us on a macro level. So every year I do a forecast, and this year it seemed kind of silly to try and get into the minutia of the market and really look at that rising tide. So that's what we're going to get into. We'll have plenty of time for Q&A as well. Resources on this, Ray Dalio, if anyone knows Ray, he is the man when it comes to debt cycles. So Principles for Navigating Big Debt Crises, that's a huge book that I've had the pleasure of reading, and then he has the Changing World Order coming out soon as well, and then his website, principles.com. And then Daniel Ammerman is a financial analyst that I follow as well. So I've got a lot of his graphs that really show good detail on how the Fed and how fiscal policy and monetary policy work together to kind of shape our market. So that's what we're really going to get into today. Quickly, my thoughts on the recession that we've seen is, coronavirus started the recession, but it's the government intervention that framed it, right? And so a pandemic like we've had, that's not a black swan event, but the government's interaction or intervention really is the black swan event. So they, forced us off of an economic cliff, and then by using the monetary policy tools at hand, they created that bungee cord effect. So we are in crisis containment mode, and that's going to continue for the next 2 to 3 years. And then as we see through a bunch of different graphs, that's going to be a rising tide for assets and real estate, bond, gold, crypto. They're the big winners and all that. We will talk a little bit about how do we deleverage. If anyone really wants to go down that rabbit hole, I'd Google financial repression. That's how we pay down debt over a long period of time, and we'll talk a little bit about that. And then really the biggest problem moving forward is financial inequality, which is now talking points at the Fed level, the central bank level, which historically has not been. And then with interest rates so low, we're interest rate sensitive in the markets, and so you can see wide swings happening right now in the stock market as yields and interest rates change. So let's get into this. I think, again, the ocean's the right analogy right now. We can talk about all the little ways, eviction moratorium, foreclosure moratorium, all those little ways going back and forth, but the thing to pay attention here is that rising tide of the Fed, and so that's really what we're going to get into. So here's the 164 years of business cycles. So you can see our expansions and our recessions, and you can see right there during the Great Depression a big change. So what happened here to change how our business cycles, the length and the time? And if we zoom into that, so from the average business cycle for that entire 164 years is 40 months of an expansion and only 18 months of a recession. But if we look from just 1946 to 2018, those expansions get significantly longer and the recession significantly shorter. And that's directly because of the way that the Fed, the central bank, now involves themselves in the market, and that sometimes they even work hand in hand with our politicians to then create monetary and fiscal policy at the same time. So there's essentially 3 tools that the Fed uses, or the central bank will use. So they raise and lower interest rates, so we know about that. That's something that we're very familiar with. It's a talking point every time the Fed meets. On average, when we're in containment crisis mode, or crisis containment mode, you'll see an average lowering of the interest rate 7 to 8% historically. Unfortunately, since the last 4 recessions, we haven't had as much ammo to lower interest rates. And so then that started getting us into monetary policy number 2, which is quantitative easing. And that's just financial asset purchases, bonds, and treasuries. And so that's the interest rates. The Fed can manipulate interest rates to I apologize, I've been really sick, so I'm doing my best I can here. So they can manipulate interest rates to an extent from bank over bank lending. Quantitative easing is then putting money into the economy and pulling money out of the economy. So that's their two tools essentially. Is we're going to add money to the economy, we're going to pull money out of the economy, and then we're going to manipulate how banks charge rates to each other. And then that does have influence on the rest of the market. And then monetary policy tools number 3. So this is when you have fiscal policy and monetary policy working in coordination. And what we need to understand is the central bank cannot spend money, right? They can print money and they can provide credit, but they can't actually spend money. So they're limited into where their money printing goes and gets into the markets. On the other side, Congress, the Treasury, they can spend money. And so what's significant about monetary policy tool number 3 is now you have the government and the central bank working together to add more money to the economy from a lending and from a credit facility standpoint, it's the central bank, but then also from the fiscal side, putting money into the economy through PPP loans, direct checks to consumers, expanded unemployment, all that type of stuff. So we're seeing monetary policy tool number 3 in effect, and we'll get into some more details on what that looks like later on. And again, Ray Dalio is the man when it comes to this stuff, so I highly recommend getting into his stuff. So the Fed funds rate. So here's interest rates. So historically, between 1962 and 2000, this is our average interest rate, 6.8%. That's the Fed funds rate. And then due to our dot-com crash, they changed that average from 2002, from 2000 on, now it's less than 2%. So you can see that that dot-com crash had a significant effect on the Fed funds rate and the tools that they have to that. If we add this same graph and we look at these crises, these recessions, you can see the exact same thing. So interest rates go up, recession comes, interest rates go down, economy gets better, we bring our interest rates back up, recession comes, we bring our interest rates back down, and so on. And then after the dot-com crash, one historical change here, and then after the Great Recession, huge historical change there. So we'll unpack that. But you can see every time we try to bring interest rates back up, then they need to lower them to get through a recession. And historically, we've had a lot more gunpowder in that tool available than what we have now. Home prices, normal home prices trend, you can see our bubble that we created there in the Great Recession, and then again, increases since. There's some good graphs that Daniel Ammerman put together on interest rates and then home price values. So here's, again, the average funds rate here from 1975 to 2000. And you can see the interest rate above that average and below that average. And historically, interest rates will come back to the mean. So historically, we'll see that both from the housing values and from an interest standpoint, if we have the mean, we're going to come back to the mean until we got into the dot-com crash. And that's where we had to shrink interest rates to the floor, and then we have this outlier. And then you can look at that direct inverse approach to housing values, right? So again, housing values prior to the dot-com crash, they would always come back to that mean. Until then, we had this significant lowering, interest rates down to 0.98%, then the bubble, and then the crash, and then again, now even more historic rates, and then a bubble creating again. And so just as we've had interest rate outliers in the past 20 years, we've had housing price outliers in the past 20 years because they correlate and they go hand in hand in that scenario. So let's look at these policy tools in action. So in 2001 into 2003, so that's 50-year low, they pushed interest rates, the Fed funds rate down to 0.98%. So we hadn't seen that in 50 years. Then in 2008, then they slammed it down to 0. So first time ever, we've been in that 0 to 0.25% range, and then they maintained it through 7 years. And so essentially 2008 and lowering that interest rate down to the floor is what created quantitative easing, because we didn't have the ability to lower interest rates anymore. So that began our first monetary quantitative easing, and then the expansion of the Fed balance sheet, which gets really interesting. 2010, we took on $1.7 trillion of national debt. This is significant because it was 3 times the largest amount of 1-year debt added to the national debt since 2004. So the record prior to that was 589 billion. So in 2010, we're in crisis mode. We need to print a lot of money. We need to take on national debt so we can fund things like the bank bailout and the car bailout, and all the various credit bailouts the government needed to do at that time. In 2016 to 18, our economy started recovering. So then the Fed tried to reduce its balance sheet. So we got some good graphs to show how it expanded. And then when the Fed started to reduce their balance sheet, then we started having taper tantrums, and markets started to slow. So the stock markets were not liking how the Fed was now trying to pull out of the market, and then we saw the market start to slow down after that. 2019, we had the dreaded yield curve inversion, so we'll get into that as well. But the yield curve inversion has historically predicted a recession that's followed, so we'll get into some of that as well. And then we started having quantitative easing again after that, prior to the coronavirus. So here's that yield curve inversion. So you can see our recessions in the light gray, and essentially, if you hit the yield curve reversion, recession followed. Recession followed, recession followed. In 2019, we quickly had a yield curve inversion, and then immediately the Fed took advantage of it. So immediately they dropped the overnight rate again, the Fed's fund rate, they dropped it down. So they were increasing the funds rate prior to that. So immediately they dropped that funds rate again overnight, and then they backstop the markets, which is what they do through their verbiage. And so they make a commitment to then start buying financial assets to the same pace as they were through the Great Recession. So they essentially said, we have not expanded our balance sheet. We've tried to lower our balance sheet. The market didn't react. And so now we're making a commitment to increasing our balance sheet again. And so that's the Fed backstopping the market, by having a commitment to buy financial assets to then put money into the economy, into the hands of the top level investors, so they can recirculate that through investments into our economy. What happened in 2020, first time ever, all of our treasuries, they went below 1% yield. So the 10-year, the 30-year, and the 5-year all went 1% yield curve. And so essentially what's happening is, as the coronavirus is going through, we're shutting down our economy, investors are looking for safe haven investments. And the treasuries are that. They've got they've got a printed yield or rate of return that a treasury note will give, and then the prices of those go up, lowering yields when demand flows in, and that's what we saw. So a significant amount of the debt was actually bought by our central bank. So the central bank increased their asset sheet by 108% in 2020, and then mutual funds increased their amount of government securities by 83%. In 2020, foreign investors only increased their amount of government debt by 6%. So the funding of all these securities was really through mutual funds and from the central bank. And we'll talk about that more if you guys want to talk to it. But here's monetary policy number 3. And so if you look here, least direct on the left, on the bottom, most direct on the top. And then who we're targeting to, the money. And immediately, almost overnight, we went through the top level areas of monetary policy number 3. We implemented them. So the central bank provides printed money directly to the government. So expanding our balance sheet by, I think, $3 or $4 trillion last year. Central bank provides printed cash directly to households, so helicopter money. So PPP loans and then stimulus checks to citizens. So monetary policy, when Ray Dalio wrote this deep into LinkedIn in 2019, what's at the top is the hardest to pass politically, right? So you have to have a certain level of political will in order to get this stuff approved by Congress. Almost overnight, every politician out there was on the board of getting into the most direct levels of monetary policy number 3, just because they made the decision to shut down our economy. Now they're making the decision to try and bail everyone out. So it was like this perfect storm to now have Congress work directly with the central bank to make sure that the economy still had money in it, or you keep the money flowing. So here's what it looked like in action. So immediately, so on the unprecedented Sunday, so was March 12th, right around there, is when the government started shutting down. The first time ever the central bank has met on a Sunday, and they used all their gunpowder up. The interest rates, the Fed funds rate was at 1%. They lowered it to that bottom tier, 0 to 0.25% immediately. So the central bank said, we're going to start taking action. We're going to start taking significant levels of action immediately. So they did everything they could from the interest rate, and then they immediately went to financial crisis level quantitative easing. So they made a commitment to then purchase, I think, $120 billion of financial instruments every single month. So that's the Fed stepping in immediately. Then in 2020, we added $4.5 trillion to the national debt. So on the fiscal side, we could start spending money. Congress could then spend money to again put more money into the economy. Sorry, one last check here. Yeah. Okay, I apologize. No more people are coming into the office. So we added $4.5 trillion in national debt, which is significant. We'll look at that. We got some good graphs there as well. And then they instituted those most effective monetary policy number threes without a thought. So that's government taking action with the central bank to make sure that money is flowing in. So when it comes to printing money, inflation is the big word, right? So everyone's saying inflation, 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 we're printing all this money, which is true. But what we have to do first, before we see any inflation, the amount of printing has to offset the lack of spending and the credit. So as consumers pull back because we didn't have jobs, so we're not making money, we're not spending money, we're not borrowing money, printing is offsetting that. And then inflation doesn't start coming in until the amount of printed money is above and beyond that gap that's created from lack of spending and credit. So there's a lot of talk about inflation, but as the way that the Fed measures inflation, consumer prices, we haven't seen any. And so that's where we're getting kind of a mixed return, that K-level return in various asset classes because of the way the printing has been happening and who's getting that money to. The Fed also did unprecedented lending programs. So they started expanding their asset purchasing. So they started buying junk bonds. In the Great Recession, they started buying mortgage-backed securities. But then the initial thought, because of retail, office space, and then apartments, they were concerned about the commercial mortgage-backed security market as well. So then they started purchasing commercial mortgage-backed securities. So the thought process here is all the people that hold this debt are getting reimbursed by the Fed. So the Fed is purchasing those financial instruments, putting more money into the market in the hands of the upper level investors, and then the investors are now investing that money in different ways. So that's how the Fed is putting money into the economy. Fastest crisis ever. So on average, a bear market lasts about 14 months. Recessions are defined looking backwards, so we haven't defined what this recession is, but there's an argument to say that our bear market lasted a month from the stock market, and then the recession on average is 15 months, maybe 6 to 9 months for the coronavirus, and so we'll take a look at some of those graphs. So this is a one-year look on the stock market. We look back 5 years, here's our corona cliff that we went off, and then we've seen a significant trending upwards since. So obviously, when you print that much money and then you put that money into the hands of investors, they are going to invest that money, and that's shown up immediately in the stock market. GDP, so you can see the initial drop because we didn't start the shutdown until late Q1 last year, so the significant impact was in Q2. Then we passed the CARES Act, so we had a significant rebound in Q3, and then we've had an upward in Q4. So you can paint a picture for, again, this being the shortest recession ever, and a lot of that has to do with the Fed. So let's put $4.5 trillion into context here. So from 1776 to 1993, over a 217-year period of time, we took on $4.5 trillion of debt as a nation. So in 1 year, we took on more debt than we did in the first 217 years of our nation. If we adjust for inflation, now it goes to 208 years. So 1984, inflation adjusted, we put 4.1 trillion into the market, or into national debt, and then 4.5 trillion. So that's significant. We've taken on a significant level of debt on the national level to get through this. So we can look at some trends of our national debt. So if you go to us.debtclock.org, we can look at this real time. They even predict it out. So we had 7 trillion of debt in 2004. In 2008, it grew to 9.7. So that's 9.5% per year growth in debt there. From 2008 to 2012, now we took on more debt because of the Great Recession. So that was 13.2% per year of additional national debt from 2008 to 2012. Not quite as much from 2012 to 2021, 9.7% per year. Here's where it gets a little scary. So they also predict out what debt can be. So we're predicting out, our federal government is predicting will be $49.5 trillion in debt by January of 2025. So that's 19.4% added to national debt for the next 4 years. So we're in this cycle of now just having to print more money, take on more debt in order to spend our way out of recession. So that's crisis containment mode. So let's look at the Fed balance sheet. So here's the Fed balance sheet from 2002 to 2018. So we had this ceiling prior to the Great Recession. We had this ceiling of less than $1 trillion of the Fed balance sheet. Then when we started quantitative easing, quantitative easing is putting money into the economy. So there's two things when it comes to inflation. There's the amount of money in the economy, and then there's how fast the money moves. In the Great Recession, money was not moving. And so then quantitative easing, by buying financial instruments, giving more money to investors so then investors can spend money, that's what stimulates the economy. And so you can see quantitative easing, number one, the first expansion of the balance sheet getting us up to 2.5 trillion, then another expansion getting us to 3 trillion, and then that last expansion getting us to about 4.5 trillion is the ceiling. So again, this is Daniel Ammerman, so this is his ceiling. You can see our taper tantrum here. So 2016 to 2018, the Fed starts to pull back, reduce their balance sheet, and then the market didn't react very well, so then they started increasing their asset sheet again. Let's get into predicting that asset sheet. So this is a graph that Daniel Ammerman created early on. So I think this was March, maybe April of 2020. And he's predicting now that $4.5 trillion ceiling now being the new floor. And so he predicted by 2024 to get up to 6 trillion on the asset sheet, and about 7.5 trillion by 24, 25, 26 in that asset rate, in that time frame. Here's where we're currently at. So this is as of just yesterday or at the beginning of the week, this is the central bank's asset sheet. We're almost at $8 trillion. So he didn't predict that until not even, so 7.5 by 2025. So by 2021, took us just about a year to go from 4 trillion to almost 8 trillion. So just over 4 trillion to just under 8 trillion. So that's how much the central bank has increased their asset sheet, their balance sheet in just 1 year. Again, you can see crisis modes here, and this is the S&P 500. So we're in crisis, Fed interacts, crisis containment mode, and then we come back. Crisis, Fed interacts, crisis containment mode, we come back. Crisis, Fed reacted, and this is early on in the recession, so we don't see it, but already the S&P 500 has come back. So we have that, if you're looking just at that index, you can see that V-shaped recovery there. And so this is directly correlated to the central bank and our Congress printing money and putting money back into the economy. So we have more tools to use. So monetary policy number 3. So this is kind of what you hear on the mainstream media standpoint. We could do yield curve control, where now the central bank is is influencing the amount of yield curves for the different financial instruments. They don't want to get into it, so we won't talk much about it. Negative interest rates gets talked a lot about, so that de-incentivizes households and institutions from holding cash. So instead of being savers, they're putting money back into the economy. All of the big central banks, Japan, Europe, China, they're at negative interest rates. There's been a lot of talk about the US, the Fed going interest negative. The Fed doesn't want to do that. They continue to talk about not wanting to do it, so they probably won't do it. This is where their focus is increasing the amount of financial asset purchasing. So again, putting more money into the economy and then expanding the type of financial asset purchasing. So that's through direct purchases and then also different credit programs. So they have credit facilities, and they created, I think, 8 or 9 emergency credit facilities during 2020 in order to get money back into the economy. They can start purchasing equities and lower quality debt, like we saw. They started purchasing junk bonds. This is what we're starting to see now, is central banks can lend to development banks for stimulus-related projects. And so what we're going to see now, think of affordable housing. There will be a big push for our government to then fund development banks to get affordable housing going. And then also the next package to come out. So we just had the $1.9 trillion stimulus package. The next package Biden's working on is an infrastructure plan. So we're putting money back in our economy through that. What's different now, if we look at now versus 2008, is we didn't have this. So this is mortgage credit availability. This is something I look at almost on a weekly basis. I want to know, because I invest in real estate and I sell real estate, I want to know how that market's functioning. The majority of buyers buy with mortgages, and so I want to know what is our credit availability and how's it reacting. Right now, if you go back, we're into the 2014 era level of credit availability, which is fine. The market functioned fine back then. We were seeing increasing prices. We're good to go there. Prior to 2008, we saw this huge collapse, right? So we had all the subprime loans. We had lowering interest rates at the Fed level. So I remember back in 2006 getting a 6% interest rate loan, thinking that was amazing because interest rates were coming down over that period of time. But as different loan programs started pulling out, your forward-payment loan programs, your subprime lenders started going under, that crash of credit availability is what turned off the spigot to the money moving inside of the real estate market. So we don't see that right now. If anything, we've got more money moving through the real estate market. And so I think it was mortgagebankers.org. I think they predict a record year of lending this year. It's either $3 trillion or $4 trillion in mortgage loans this year. So money is flowing through our real estate market fine, which is why we're seeing upward pressure on pricing. Interest rates are significantly low, making affordability high, and then not enough supply is what's pushing interest rate or pushing values up right now. So once in a lifetime real estate market, interest rates are going to continue to put asset prices higher. We've seen some tapering of that. Obviously, interest rates went up about 0.4 of a point in the past month, but they're still really low. The Fed, even with all the talk of inflation, with bond investors pulling out of the bond market, seeing yields go up on bonds, which is pushing interest rates higher, the Fed still is not going to take action. So the Fed's new policy that they implemented last year is they want inflation to run hot. So prior to last year, they had a target inflation rate of 2%. They're just trying to keep inflation at or around 2%. After studying various economy cycles, the Fed changed their program last year, saying we're going to shoot for an average of 2% inflation. So for all those years that we had less than 2% interest, that means we're going to have the subsequent amount of years above 2% interest. And so that's why right now you have all this talk about inflation. And the Fed keeps saying we're not going to increase interest rates. We're not going to increase interest rates. We're not worried about inflation. They need inflation to run higher than interest rates in order to pay down debt. So that is the premise of financial repression, which is people that save money at the bank level are getting a yield or a return on those savings of less than the inflation rate. So then that forces savers to pay down our national debt. And so that will be the way that the Fed goes. They'll allow inflation to run hot. So we shouldn't expect the Fed to really make any changes. Now, the conversation is going away from 2023 to sometime in 2022. The Fed will start taking action. But the Fed isn't worried about it because they can. They can increase interest rates, which will then tamper down inflation. So they're not really worried about that. Our interest rates are tied to the bond market. The bond market's very volatile right now, but it looks like it's starting to level out a little bit. So we can still expect interest rates to stay in the 3% range for real estate mortgages here going forward. More financial asset pushing low yields lower. So we talked about mutual funds buying the treasuries, and so that was lowering the yield on treasuries. That's been changing now. So as inflation becomes more of a concern, now mutual funds are pulling out of the financial yield, and so yields are going up. But that means they're having to go buy different assets, and they're looking for yield. And so with bond yields so low, they now need to start looking at different types of assets. And so that's going to push those assets values higher. So think about real estate. After the Great Recession, we had Blackstreet, I think is their name. They created the single family funds, right? So they bought up all these single family rentals, turned them into funds, and then started selling stock shares to essentially single family homes. They're working with, I think it's Starwood now, to do that on the multifamily side. So we're seeing Wall Street moving into real estate, and I don't think that that's going to change. Reduction in yield and then moving large sums of money into real estate then compresses cap rates. Again, interest rates have changed since I did this wrote this presentation, but you still have the demand coming in and all the money coming into the market. So we haven't seen an increase in cap rates. The bigger thing is reducing yield keeps investors from having dividends that they can reinvest. So when you look at building wealth over a long period of time, reinvesting those dividends is truly what gains net worth. And if you don't have much dividends, much yield to reinvest in that, again, changes your ability to create wealth. And so then they look for different strategies to build wealth, again, buying real estate. Because real estate does provide that. It's not a yield, it's cash flow, but that allows you to reinvest and compound that wealth. We haven't seen consumer inflation yet. So again, that's the Fed. They're not going to react until they see consumer inflation increase, which we haven't seen. We've talked about this. The printing's just been offset lowered spending and credit that's created by the downturn. We can see since 2001, real estate prices are heavily influenced by the Fed, and the recent actions and predicted actions going forward are just going to continue that trend. We trigger their actions without actually having to hit to housing prices. The stock market moves very, very fast. So the stock market took a hit because it can move overnight, but the real estate market moves so much slower that we didn't get the chance to take the hit because the Fed interacted with that bungee cord effect immediately. But inflation, even though the Fed says we're not seeing it, we can see it showing in all of our asset classes: real estate, gold, crypto, stocks. So it's just coming from investors because, again, the central bank buying financial assets, putting cash, so larger investors, institutional investors trading their financial investments for cash, then go spend that cash on assets. And so that's what we're seeing. So even though we're not seeing it in the consumer side, we're seeing it on the asset side. We are headed into monetary policy number 3. We just passed $1.9 trillion of it. Again, more direct checks to Americans. Biden is going to create a first-time homebuyer tax credit. So 2008 was when it came out. It was at $7,500, and it was not advanceable. What he wants to do is make it a $15,000 tax credit, and he wants it advanceable. So you can actually borrow that ahead of time rather than get reimbursed on your tax return. Increased minimum wage, that did not get included in the $1.9 trillion package, but I guarantee you that discussion has not gone away. Debt forgiveness, that's the PPP, latest PPP deadline is going to get extended again, and then college debt. Biden wants to create the ability to write off $10,000 of college debt without that having a tax implication. So we're still in this monetary policy number 3 setting. Refi booms, right? So with low interest rates, we're triggering refi booms. That makes it more feasible for property rentals. That keeps supply from hitting the market. And then again, demand will remain strong, keeping supply levels low. So because unlike in 2008, where demand pulled back immediately and supply increased significantly, creating a huge amount of supply, demand's actually pushing in, supply is pulling out, so we have those ridiculously low supply levels now. And that's just continuing to put pressure up on our prices. Drivers limiting supply, refi boom, physical fear of the virus. There's still sellers that just don't want to come to the market. And then construction costs and timelines. So here locally in Portland, you look at lumber prices all across the nation have increased, but construction costs, so soft costs, and then the time to permit is increasing significantly. So permitting is way down for 2020 compared to 2019. So again, that's going to be a gap in the supply side where we've already have more households than we have housing units. That's just getting exacerbated by this vast demand. So once this wave of new apartments gets filled, we're going to again go to an undersupply of housing. And then we've had past 5 years of rent increases, again, making rentals much more affordable. So people, instead of selling a home to buy a new one, refinance their existing home, it pencils their rental, go buy a new home. So typically that move-up buyer is a net zero to the supply levels because they're buying a home, but they're adding a home. Now they're buying a home, but they're not adding a home. So again, that's exacerbating supply again. Increasing prices should pull more sellers in, but they didn't last month, so we'll see. Again, high effective purchasing power at those interest rates should be pulling sellers in. We just haven't seen it. And then technology allowing us to show homes without fear, and then the vaccine. So potentially we've got some things on the horizon that will add supply or inventory. We'll just see if it adds more inventory than demand increase to see there. So demand drivers, affordability is what's been increasing demand, even though prices have been going up. With interest rates going down significantly, affordability's gone up. Debt forgiveness, again, college debt, allowing a write-off in college debt makes millennial first-time home buyers much more, have the ability, much more effective in their purchasing power, and then adding a first-time home buyer tax credit to that, again. Accommodative monetary policy, that's not going away, and then reducing demand. So fear, I'm not seeing fear in the marketplace. That's one thing, it happened immediately in 2008, 2009. We just saw a lot of fear and demand pull back. We're not seeing that right now. We're seeing demand push forward. And then we are interest rate sensitive. So I've got some affordability projections here we'll get into. Those are actually historic now because of the way that interest rates have increased. Mortgage rates have increased over the past month. So headwinds, long-run economic damage, that's the concern. So now we've got 12 months of unemployment for a lot of people. They start losing their skills. And so how do they get rehired? So although our unemployment rate's coming down and it's coming down fast, there is concern of going from 4% up to 15% back down to 7% was pretty fast. But getting from the 6.2% we're at now back down to 4% is going to take longer because of that long-run damage. We are sensitive to interest rates. It's not showing up in the Portland marketplace yet. Demand is still ridiculously high, even though interest rates went up, because they're still historically low, but we are sensitive to that. So when interest rates are 3%, a 0.5% increase is much higher than a 0.5% increase when they're at 4%. So there is some sensitive to that, and then it could potentially start to see demand taper because of that. Politicians, especially here in Oregon, we just don't know. Eviction moratoriums, foreclosure moratoriums, there's a lot of housing agendas on the House floor right now. So we'll see how that stuff works out. But they are going to interfere with how the free forces of the market in the housing side. And then lack of inventory. If we don't get inventory, we just can't sell houses. And then how do we deleverage? There's going to be a headwind. So let's get into local affordability. How are we doing on time? Okay. So here, 2003 to 2011. So 100%, that's what's affordable. And so that's 25% of your gross income can go to your principal and interest. And so that's at 100%. You can see we got unaffordable right before the Great Recession. And we had the Great Recession, we got very affordable again. Where we're at right now is we're back to 2015 affordability. So again, we've seen the most affordable market that we've seen in the past 6 years. We are you can see in Portland here, we got back down to that 100% level in 2018. This was actually a flat, considered a down market for Portland. So mid 2018 to mid 2019, Portland was pretty flat. Our prices were flat. Almost every trend was flat. Supply levels were pretty consistent. They're up above two months of supply. And then interest rates started going back down. So the Fed's interaction to taper tantrum, lowering interest rates, then made interest rates lower on the mortgage side, and then affordability started increasing. So as you can see, market's very affordable right now. Here's what those numbers look like in December. So median income of $92,000 means $1,900 a month on your mortgage would be that 100% level. With the median sales price of $455,000, put 20% down, so you have a $364,000 loan. It's only 19% of the income, so affordability was at 130%. So I like to project affordability. So scenario one was a 10% increase of the median sales price, and then getting interest rates to 3%. So back in December, they were at 2.67. So let's raise it to 3% and add in a 10% rent increase. Affordability is still 112%. So that means our market could go up by 10%, interest rates could go up, and we still have what's considered an affordable market. And this was back in January. Now interest rates are higher than that. I think they're 3.17%. But you know, back in January, people thought I was stupid for projecting interest rates at 3%. Not looking so stupid anymore, but I do expect it to get even higher by the end of the year, like 3.25%. But I also like to solve for 100%. So if we kept interest rates at 3% and we were to solve for 100% of affordability, that means our median sales price could get to $568. So that would be 25% increase. Our median sales price could go up 25% before we get into the 2008 territory. We've already seen a big portion of that happen. But again, affordability is not at 100%. So if we change this number to 3.25%, this median sales price would come down, but it's still significantly higher than it is now. So where we're at from a market standpoint, with where interest rates are at, where median sales price is at, and where incomes are at, we still have room for our market to run from a pricing standpoint before affordability will start slowing it down. So that's what I've got for the micro level on this stuff. And then, so volatility is here to stay. So with the Fed interacting the way that it does, we can expect that volatility to be here. So big upswings and big downswings are going to be the modern norm. The latest report, 15%. So our median sales price of February last year compared to February this year is up 15%. That's a huge swing. And we can expect that to happen. I expect more big swing upward before we do see a downswing coming in the next couple of years. Savers are screwed. There just are no low risk options out there. So there's no yield. So they're going to be getting a yield less than inflation, which means they're going to be losing the value of their net worth as inflation is higher than the yield options that they have. Good debt. So right now is the time to be a debtor, right? I understand debt significant. Understanding debt is one of the keys to our success. We built a large rental portfolio here in the Portland area. I'm at the point now where I'm actually overpaying for real estate. Recently, I made a $1.2 million offer on a $1 million fourplex because the offer was for 30 years financing at 2% interest. And so again, understanding our current interest market, good debt, 2% interest, allow that property to cash flow now. So I can overpay by $200,000. It still cash flows now, but then I've got a locked in 2% interest rate for the next 30 years. So that's a very low risk scenario, even though I'm overpaying for the property by today's standards because I understand the finance side of it. But don't just buy to have mortgage debt. That mortgage debt still needs to make sense in the terms of the deal. So in that scenario, I'm overpaying, but the balance of payments was there. So in a debt crisis, what's more important than the amount of debt is the balance of payments. So the amount of income coming into the amount of debt servicing going out. So in that scenario, it made sense. Stick to fundamentals for your acquisitions. Everything needs to cash flow in order to weather that future storm. Learn seller financing. So with yields being so low, with baby boomers now going to be the biggest asset transfer in our history, They own the most amount of real estate. They're going to start transferring that amount of real estate. Seller financing is going to be a huge key for them, especially when we have talk about increasing the capital gains rate, removing the ability to 1031 exchange. That's been on the shelf for a long time, but it's getting more traction now with the Democrat-led Congress. And then removal of stepped-up basis being on the discussion field as well. So all that stuff then makes seller financing, which is already a good tool for baby boomers, it becomes a much better tool for baby boomers. So for enders, and then it'll create win-win tools. So it's a great way. Again, if banks are lending at 3 to 4%, then you as a buyer of seller financing, you have something to contrast that against. So there's no reason to pay any more than 4% for seller financing, and you can set that up for a long period of time. And that's going to be a much higher yield than baby boomers would get if they're going to put their money at the bank, or if they're going to look at other low risk assets. Those things. So there's kind of a wrap up for it here. We can get into some Q&A. I'm happy to get into that.
All right, Mike, there was a ton of information there, and we're starting to get some questions in the chat over here.
Yeah, how do I find the chat?
Oh, I'll read it to you. Don't worry.
Okay, cool.
As the speaker, you concentrate on your talk, and I'll read you the questions.
Awesome.
And if people have questions, feel free to put them in the chat. Mick is asking, and this is from the middle of your talk, would it be right to think that once more government-sponsored affordable housing happens, that current real estate investments will be devalued?
No. There's just two completely separate buckets. They're nationwide, and then both locally here in Portland, we just have a housing shortage crisis. New construction starts they've been lagging for decades as households have been increasing. Now our population growth rate is going down, but there's still a mismatch for the amount of households that we have versus the amount of housing units that we have. And then that gets even more exacerbated when you get into the low-income housing, or then the government subsidized or the government regulated low-income housing. And so, especially here locally in Portland, the amount of money that we've created 700, almost $750 billion of bond money here locally. It's like a drop in the bucket to the need. So even though they're going to create more funding for that and more value for that, market rate housing is still going to exist, and it's still going to provide plenty of yield, because that's such a small, the subsidized housing is such a small percentage of the housing units out there.
All right, next we have a question from Amaya. What is driving the expectation that demand for RE will stay strong, and what is the time frame? I think you've probably gone through a lot of this detail already. If you want to make a quick comment on it, that's fine. Otherwise, I can go to the next one.
Yeah. So it's getting more money, so printing more money, getting into the hands of institutional lenders is one thing, and then low interest rates is the other. So the amount of money and the low cost of the money is that floating rising tide for real estate.
All right. And let's see, this is really good. Can you please go to slide? Let's see. Oh, can you comment about housing in the Beaverton, Tigard, and Hillsborough areas, the areas that are in the suburbs of the Portland market?
Yeah, Intel land. I absolutely love Washington County. So as a firm, we really only invest in Portland because we want a really small physical footprint for efficiencies. But our tertiary markets are amazing, especially with the more adverse laws and regulation that Portland puts into the core. That pushes demand out. So Portland Metro is still a great place to invest. I don't think many investors feel different than that, but Portland is losing its luster. And so the next best thing then is now Hillsborough, Beaverton, Intel. If you also look at all the construction boom outside of, the community in there in Hillsborough, Orenco, outside of Orenco Station, you're not seeing a lot of apartment buildings being built. You get some in the Tiger Triangle, you get some in Beaverton, and they're bigger complexes, but it's not like Portland where you've got, 30, 35 cranes in the air. So again, that housing shortage, the number of households versus housing units, it gets even more exacerbated as you get out of Oregon. When you look at the urban growth boundary, it's all precedented on Portland taking on the majority of density. And so that means the transit-oriented districts, the higher density zonings are in the city of Portland. And you're going to see less building in those tertiary markets. So again, you're going to have a bigger shortage of housing out there. So when it comes to those markets, income's great, housing shortage is there. You still have the urban growth boundary that's going to reduce the ability to increase that housing. Population is still growing. And I'd expect as Portland Metro population grows, I expect more of that to be in, the Clackamas and Washington County areas.
All right, we've got about 2 minutes left and maybe 3 or more questions. Next question, can you go to slide 64 so we can get the information about Investor Lab?
Oh, yeah.
And for Anna Marie, I put that link in the chat as well. Zachary is asking, you said something about purchasing a home, bless you, purchasing a home for more than you can afford now, but making sense in the long term because of the financials. Can you say some more about that?
Yeah, not more than I could afford, more than it's worth. So in that scenario, $1 million is what the property's worth. We offered 1.2 million because that came with 2% interest rates, which made it affordable. So had I paid 1.2 million at 4% interest, it would have been a negative cash flowing asset. But by lowering that interest rate, so the balance of payments, now it's an income producing asset. And with an interest rate locked in for 30 years at 2%, it would have to take a significant downward trend in rents in order for it to not be affordable. So the key there was it was affordable because of the low interest. It just was more than what it was worth. So in this specific scenario, the seller really wanted 1.2 million. That was their thing, is we want 1.2. And my response is, it's not worth 1.2, it's only worth $1 million. I'm happy to pay you 1.2, but this is the deal structure. It needs to be seller financing, it needs to be a low down payment, and it needs to be 2% interest. So affordability is different than worth.
I was going to say, if you want to find out more on that topic, I'd highly recommend. About 3 weeks ago, we had Jason Hartman in, who talked about inflation-induced debt destruction. Basically, the idea that your inflation rate is going to run hotter than your interest rate, which makes your loan an asset.
Yes.
And so you can find out more about that at one of our previous talks. I'll put the video.
Jason's great, and that is financial repression. It's the magic to pay down debt, which means we want to own debt, or we want to be in debt.
And I think this will be our last question because we are right at the top of the hour. There's lots of questions about market downturns, which, but I'm going to go to Andrew's question here. Mike, can you speak to what you expect to have happen in the Portland rental market when the residential infill project goes live?
Yeah, I don't think the residential infill project will actually do much in the rental market. It's actually not predicted to provide many more units per year. And the financials of building small scale rentals just doesn't work out. I think it's actually going to be more of an impact in the condo market. So what we're actually planning on doing, we're partnering with builders, and I've seen other developers get into, is using the residential infill project to build two to 4 unit properties and then condo convert them so they can exit as condos, maximizing their price per unit on the resale level. But I don't think you're going to see a lot of rentals out of it. That small scale doesn't make a lot of sense on your rental. They just don't cash flow.
All right, Mike, thank you so much for coming in and talking to us. I'm sure there are going to be lots of people who are going to want to follow up with you. So feel free to follow up with Mike, and I hope you all have a great weekend. Thanks you, Mike.
So much. Thank you, Daniel. Again, I apologize for being sick and my brain being slow. I felt like I struggled.
Yeah, it happens to all of us.
Awesome. Cool. Well, thanks so much, everyone.
Thank you.
All right. Adios.